so you can keep them on your radar. And there's one emerging topic that's getting a lot of focus at the minute that we wanted to spend some time on today, and that's the impact that ESG is having on corporate reporting. And our resident expert on all things ESG will take us through some of the hot topics in this space. So, Caitlin, before we jump into some of the details, why should our audience be thinking about ESG when they're pulling together their financial reports this year?
Thanks, Adam. And you're right, ESG has been bubbling away for a while now, but over the past year, we've really seen it come to the fore as one of the key topics on a number of stakeholders' agendas. As part of this, we've seen an especially big push by investors recently on the climate risk part, or the E in the ESG, with a number of investor groups becoming increasingly vocal about their expectations as to how this is reflected in financial statements that companies are preparing.
So when you have your investors telling you that they're interested in an issue, it sounds like a pretty good reason to pay attention. But why are investors so focused on the issue?
Well, we aren't analysts, but in the absence of clear local regulation, it could be argued that investors are willing to take on the fight themselves. But if I think about it purely from an accounting perspective for a minute, particularly with the increased focus being placed on the impact on enterprise value, climate change can have a really broad impact on the financial statements. So depending on what your business is, and think of this in the broadest sense, so your supply chain, your customer base, physical location, etc., there are so many places in the financial statements that could be impacted. The IASB published some educational material a while ago, which highlighted 11 accounting standards where you might need to think about climate risk in some way to ensure your accounts are materially correct. It's also worth noting that ASIC has been very clear that this is a focus area for this year, and it would be fair to assume that where there has been no mention of climate within your actual financial statements at all, within estimates and judgments, for example, ASIC would be expecting that management have validated that there actually is no impact. I think what we'll probably see for most of our June reporters is that they have at least disclosed the areas in which climate has been considered and the fact that there is or is not a material impact.
Yeah, I saw that IASB publication, and I think it really helped me focus on all the areas where there could be an impact in the accounts. There's a lot to think about though, so what would you say is a good first step to start thinking about this?
Yeah, there's definitely a lot to think about. I think the first step is that no matter what your industry or your business, it's really to understand where your company is on the journey related to climate risk. So before you dive into the accounting, you need to step back and think about the level of risk faced by your company, and then what are your company's plans to address these risks, and what have they said to the market in relation to the steps that are being planned. Maybe there's been already some kind of a commitment to net zero emissions by a particular date, and that commitment is usually going to require some kind of transformation actions to be achieved. So understanding all of these possible changes is going to be really important when we come to try and reflect climate risk in the accounting.
That actually sounds like a great first step. So without trying to worry about the accounting, people should start engaging internally to ensure that the finance team is across the plans the company has to address climate risk. Now, I also often hear people talking about reflecting the Paris Accord assumptions in their accounts. So is this the next step after you've understood what your company's plans are?
So that is actually a really interesting point. And maybe I'll just start with a really brief refresh on what the Paris Agreement is. The Paris Agreement was signed by 190 countries plus the European Union, and really the objective was to reduce greenhouse gas emissions and therefore reduce the impact of climate change. Many countries have adopted the agreement, and they've also submitted targets that they hope to achieve, which usually focus around net zero emissions by 2050, with some interim targets along the way. Now, given that these targets are out there, investors are often asking the question, are these financial statements Paris aligned? But actually, the answer is often much more complicated than the question implies, and it needs a bit of an understanding of how the accounting standards operate to be able to unpick it.
Okay, so what do people need to think about?
Well, Adam, investors might expect that every balance in the accounts has been adjusted to reflect those assumptions that are needed to meet the Paris Agreement, But it's actually not as simple, and companies really need to have a think about what the impact of the agreement is going to be on their business and how this interacts with the accounting standards. As I mentioned earlier, there are 11 accounting standards that we might need to think about. So we won't go through all of the details, but let's talk through a couple of principles that might be helpful when reflecting climate change in a number of different balances. So the first is how we reflect climate risk in accounting estimates. We often need to use best estimate when measuring balances, and we might do this by selecting the most probable outcome, or if there are lots of different possible scenarios, we might use a probability weighted approach. So let's use an example to demonstrate this. We might be trying to estimate the useful life of an item of PP&E where there is a 75% chance that the asset will be able to be used for 50 years, and there's a 25% chance that it will only be able to be used for 20 years because of a potential legislation that might come in to meet the Paris targets. In this scenario, the useful life could be 50 years if we used the most probable outcome, or alternatively, given there are different possible outcomes that vary significantly, we might use a probability weighted approach instead.
Okay, so I'm seeing it's not as simple as just knowing that the Paris Agreement exists and updating all my estimates to align to the targets. It's going to be important to assess what the potential impact of the Paris commitments could be, as those potential scenarios may or may not impact my best estimates.
That's right. It's going to be really dependent on the type of business and the countries in which you operate. Let's demonstrate this point again with fair values of assets. So where we are measuring the fair value of an asset, we're looking to use the amount that a third party would pay if we were to sell the asset. Let's say we have some shares in an ASX listed oil and gas company that are measured at fair value. Because the company is listed in an active market, we have to use the quoted price, and we really can't make any further adjustments to that price to reflect climate risk. And this is because those quoted prices already reflect the market participants' assumptions, including climate change.
Again, it's really not as simple as just making some adjustments to all of our balances in the balance sheet to call our accounts Paris aligned. We actually need to think about how the accounting standards work and what the balance is that we're trying to account for.
Yes, exactly.
Are there any areas where we're seeing some big impacts from climate risk already?
I mean, we have seen some pretty high profile impairments of non-financial assets that have been attributed, at least in part, to updating assumptions. And we're also seeing a number of companies thinking about the assumptions they're using in their expected credit loss models under AASB 9, for example, around the risk that borrowers can't meet their repayment obligation due to changing legislation.
Okay, so I guess the key message for our audience is that the time to really start being critical about your assumptions is now, because we are definitely starting to see changes in the market.
Yeah, and actually just one more thing for people to be thinking about is materiality. The AASB and the AUASB issued a joint bulletin a little while ago on this topic. And the key message here is that when assessing materiality, quantitatively is not enough when it comes to climate risk. So for example, a company might have entered into some power purchase agreements in order to transition to a greener energy. Those power purchase agreements might have a small quantitative impact on the accounts, but the fact that the company entered into those agreements and the financial impact is small might be material information for the investors when they're trying to assess the impact of climate risk and how that's impacting the company.
Really good point. So again, that probably comes back to starting off by really understanding your company's exposure to climate risk and the plans in place to address it. And then we can start identifying what we'll need to factor into the measurement of our numbers or provide disclosure for. And if we just turn away from financial reporting for a minute, what's happening with ESG in the non-financial reporting space?
Well, the short answer to that is a lot. And over the last year, this space has been really fast moving. So for a while now, a number of different frameworks have been out there that companies have been able to follow if they wanted to, so voluntarily so far, to make disclosures elsewhere in their annual report in relation to ESG. One of the more well-known ones here in Australia is the Task Force on Climate-Related Financial Disclosures, or TCFD framework. Now, what's changed in the last 12 months is that the IFRS Foundation has announced that they'll be setting up a standard-setting body known as the International Sustainability Standards Board, or the ISSB. The aim of the ISSB is to deliver a comprehensive and global set of sustainability-related disclosure standards to meet the ongoing needs of stakeholders. The ISSB is intended to develop ESG standards broadly, but we've seen a couple of exposure drafts already, and unsurprisingly, the first topic on the agenda is climate risk, given that investors have expressed that there's a need for information on this issue urgently. We've also seen regulators start to turn their mind to this too, with the SEC recently proposing new rules that would significantly increase the requirements for SEC registrants to make disclosures about climate-related risk and introduce the need for the climate impact of the supply chain in making these disclosures. So if you're an FPI or a subsidiary of an SEC registrant, it's really one of the things to familiarise yourself with now, as it looks like there's going to be some big changes on the horizon.
So is there anything that companies need to be complying with already here?
Technically, no, there's nothing that is mandatory yet. I think the key point here is that we're really supportive of the IFRS Foundation's decision to establish the ISSB, and we suspect it won't be long before we see non-financial reporting on ESG become mandatory in some way. And this is reflected by many companies in Australia already making voluntary disclosures against some of those frameworks that exist already. So no, nothing mandatory just yet, but we'd really recommend everyone begins to turn their mind to this as soon as possible so that you're not caught by surprise.
All right, great. And for those that are interested, we also have a publication on those ISSB exposure drafts. So one to take a look at to get a bit of a head start on the direction those are heading in. That brings us to the end of our financial reporting update for 2022. As you can see, while there aren't many fundamental changes to accounting standards that will impact everyone, there is certainly a lot to be thinking about, particularly given the environment that we're operating in.